It's Brian Preston, the Money Guy.
Daniel has a question. He says, I'm debt-free. Would it be prudent to have a HELOC in case of major emergencies that would blow through my emergency fund? He says, I wouldn't spend the money. I would just have it available. Now, Brian, I know you have a history with these HELOCs. What do you think?
Now, I want to give him some credit. I liked one thing that he said there.
Oh, he structured his question in a smart way.
He did. Okay, great. I just want to make sure you caught it. Because he said, hey, I don't want to use this as my emergency fund. But is it crazy to have access to it? Is it crazy to go out there and get a home equity line? I'm still going to keep my emergency fund, but should I have it, should the you-know-what hit the you-know-what, I've got a little bit of extra coverage there if I needed it.
I'm going to give my experience here, but I want to leave the meat for you to kind of share, because I think you'll have some thoughts, because you and I have had a lot of private discussions about this type of stuff. He qualified this, so Daniel's not saying he did this, but I will tell you the mistake I made, and I don't want you to make the mistake, because you could even go listen to our archives. If you go to moneyguy.com, we do have our archives out there all the way back to 2006 when I started this show, and that's crazy long ago. And back originally, I had six figures. I had over $100,000 of home equity on a house, and banks were giving you at no cost to me. They even came to my office to do the closing documents. So this thing was easy. Not only did I not pay any closing costs, they didn't roll them into the loan. The bank actually ate all the fees, and then they drove to my office for me to sign all the closing documents. They gave me this home equity line that had a checkbook. It had a debit card. I mean, this thing was turnkey and easy. I mean, it was great. But the problem where I made the mistake, and this is what I want to make sure I clarify this for Daniel, is that I actually was using this for my straight up emergency reserves. At 3 to 6 months, we talk about with step 4, the financial order of operations. I was just using my home equity line because I felt like cash was trash and not paying anything. So I was counting on the home equity line. The problem is we went through the Great Recession. We started coming out of the Great Recession with the stock market, but real estate market, remember, doesn't recover always in a V shape like the stock market. It recovers in what's called a U-shaped recovery, meaning it might drag at the bottom for a number of years. And that's exactly what we experienced from 2009 all the way up to about 2012, where equity in your home was crushed. And I got a letter from, I'm trying to remember if it was Wachovia or Wells Fargo, because we all know these banks changed. They had shotgun marriages and all kind of things when the government started doing all the bailouts. But they sent me a nice little letter and said, hey, you know that home equity line that we gave you the checkbook on, the debit card, and told you no problem, you can use this money? Guess what? We're locking that thing down. Gonzo. You no longer can. We're going to let you keep that loan out there. Whatever you owe on this thing right now, you're golden. You keep doing what you're going to do, but you have zero access to any more of this line of credit that we told you had. So that's why I don't want you to get yourself in a pickle where you think the home equity line and the equity you have in your house is going to substitute the cash reserves. So, Bo, that's my part of it, because what Daniel said there was this was going to be above and beyond step 4, which was the cash reserves. You're just saying, hey, they offered it to me. Should I use this?
So this may be surprising. I don't think it's crazy, but there's a few things I want you to check. And here's the first one. Not all home equity lines or home equity lines of credit are created equal. Some of them have annual costs. Some of them have closing costs. Some of them have expenses and fees that you have to pay on an ongoing basis. So that's the first thing. You don't want to have something opened up that's going to cost you money that you never plan on using, because then it's just wasted dollars flying out. But let's assume that you have a great relationship with your bank and they say, hey, we'll cover the closing costs for you to do this. And I can't. Every time I've ever seen a bank do that, they say, we cover the closing costs if you decide to draw this much. So I would just kind of measure that out, because home equity lines often have floating rates. Even the products that have a lock-in period, that lock-in period is based on a floating rate based on the time that you do it. So what's the annual cost? What's the carry cost? Here's the second thing, and I think the more important, the more valuable thing. To thine own self be true. What is your behavior? Are you the kind of person that if you have cash in your pockets, it just burns you up and you got to spend it, you got to go? Because if you know, okay, I've got my emergency fund, I'm not going to touch it. I got that $50,000 over there, not going to touch it. But I got this $75,000 home equity line, and man, we really want to do the theater room. And look, I could save for it, but I got the home equity line. Instead of saving for it, I'm just going to use the home equity line, and I'm going to pay it back real quick. I'm just going to do that. So we're going to do the home theater. Well, but you know what? Spring is around the corner. We want to start entertaining. So we're going to have people like come over to the house. We need to do our backyard. We need to do the landscape and get that. But I could save for it, but if I save it, it'll be the winter time. I feel like
this is a sight into the household at night that the life y'all are living.
You know what I mean? And so it's very easy. If you give yourself access to funds, you have to know yourself, know that you won't actually utilize that. You won't actually trip over that because you got to think, why is the bank allowing me to do this? Why is the bank allowing me to sit with this home equity line? It's for that very reason. For the thought that, okay, if we just dangle this carrot out there enough, they're going to bite. They're going to take it. So make sure you understand yourself and know yourself. And if that's something that might be a risk for you, don't even allow that temptation to enter into the equation. Just remove it completely. But if you're someone who says, nope, I know it, I'm good, I'm locked in, I'm not going to use it, I literally just want to have it as a contingency and it's not going to cost me any extra to do that, I think that it's not a crazy idea.
Final thing on this is be careful of the fine print on what the bank is making you really sign on to do. Behaviorally, a lot of times they'll offer you sweeteners like this if you can assure them that you're going to keep, maybe you have to keep a savings account with over 100 grand in it over here, or you have to do something else to qualify for you for this no cost thing. Just pay attention to what those things that they're asking you to do to qualify, because there might be more cost in this, both from maybe that money could be doing something better somewhere else, like, being invested. But also I worry about the fact that whenever you sign those loan documents, because I learned this, like I said, they sent me that nice letter that said, sorry, we've locked it up. We've changed the terms of what we agreed to. Be careful, because there might be a day, and I saw this during the Great Recession, where maybe financially you're not in such a great situation. You're in a struggling situation. If they made you open up an account over here to qualify for this, but then you start getting into financial problems, if you're not doing everything over here, they can encumber, or they can take directly from that outside account because it's at the same bank. I'm just telling you, be careful. Just know what you're getting into, because it's easy when things are good to say, oh, I'll be all right. I don't have to worry about the risk mitigation. I don't have to worry about, what access I'm giving the bank to my assets and so forth. But when it gets ugly, it can get really ugly. And I'm just telling you to read all the fine print. That's why closings are miserable with me, because a lot of times I've either hired my own attorney to look at the stuff, so that has a cost, or I've at least tried to read to say, yeah, if I'm Googling terms, I need to go back to hiring the attorney to look at this. So just be careful what you're signing up for, because I guarantee you the bank has a team of attorneys that have structured this thing in a very favorable way for them.